In 1867, Russia sold 365 million acres to America for $7.2 million. The territory contained $1.7 trillion in resources. This is stage 3 of the Imperial Liquidation pattern, the fire sale execution. Picture the scene, St. Petersburg, March 1867. Baron Edward de Steckel sits across from Secretary of State William Seward with a single-page treaty. 586,412 square miles. $7.2 million. That's 1.2 cents per acre. The Russian Finance Ministry's file lists declining fur revenue, unsustainable logistics costs. It doesn't mention the gold. It doesn't mention the oil. It doesn't mention that this territory will determine who controls the Pacific for the next century. Seward signs at midnight. The question isn't whether Russia made a mistake, it's whether they understood they were selling the future of great power competition for the price of short-term debt relief. The Crimean war bills were due. The British Navy was circling. And the asset survey? Never completed. France, 1803. Napoleon's Louisiana colony was hemorrhaging cash on a 1,400-mile supply line from Paris while Haiti expedition costs mounted. He liquidated 827,000 square miles for $15 million rather than fund another year of negative carry operations. Russia, 1867, faced the identical equation: 4,000 miles, persistent losses, and a war debt crisis that made every money-losing asset intolerable. This is stage 1, overextension. Here's why this matters to you. Every government facing fiscal crisis starts reviewing which assets to liquidate, and they always misprice the ones furthest from home. Russia's finance ministry was staring at a balance sheet with a bright red line item, the Russian-American company, losing 200,000 rubles annually on fur operations that had declined 60% from peak production. The boardroom calculus was simple. St. Petersburg to Sitka, 4,000 miles via Pacific route. Resupply voyage, 8 to 12 months. Administrative overhead, 40 outposts from California to the Aleutians. Revenue, declining fur trade barely covering operational costs. The colonial footprint wasn't generating cash flow, it was burning it. Imagine the finance ministry meeting in 1866. Tsar Alexander II has just emancipated 23 million serfs, requiring massive capital for domestic restructuring. The Crimean War debt service is due. And here's Russian America on the ledger. A money-losing operation on the far side of the planet that requires naval protection Russia doesn't have. The question on the table isn't, should we sell? It's, how fast can we exit before this becomes a crisis? Here's how colonial operations become balance sheet liabilities. The Russian-American company held a monopoly charter, but monopolies only generate returns if the underlying resource has value. Fur-bearing animals were overtrapped. Sow otter populations that produced 200,000 pelts annually in the 1810s were down to 30,000 by the 1860s. The cash flow was collapsing, but the overhead wasn't. Every outpost needed resupply from St. Petersburg. Every administrative officer needed salary. Every fortification needed maintenance. And the 4,000-mile supply line meant that shipping costs exceeded the value of goods being transported. This is the definition of negative carry. You're paying more to hold the asset than the asset generates. Meanwhile, the finance ministry was managing much larger problems. The Crimean War, 1853 to 1856, had cost £100 million against annual revenue of £33 million. That's 3 times leverage on a war they lost. Domestic modernization, railways, industry, military reform required capital allocation. Serf emancipation required land redistribution funding. Every ruble spent on Alaska was a ruble not invested in keeping Russia competitive with Western Europe. Here's what this means for you. When governments face fiscal pressure, they liquidate distant assets first, and they do it without proper valuation. It's the same psychology as selling your rental property during a personal financial crisis. You take the first reasonable offer because you need cash now, and you don't spend time calculating what the property might be worth in 20 years. The overextension created opportunity for competing powers. Britain's Hudson's Bay Company was expanding operations in Western Canada, eyeing the Alaska coastline as a natural extension. If Russia maintained the territory but couldn't defend it, Britain would simply wait for the next Russo-British conflict and seize it via naval action. Russia would lose the asset anyway, with zero compensation. You might be thinking, surely Russia surveyed the territory before deciding to sell. They must have known what resources were there. Here's the problem with that assumption. Resource surveys are expensive, time-consuming, and Russia was in crisis mode. The Russian-American company had done basic fur inventory, but zero systematic mineral exploration. No geological surveys, no oil drilling, no comprehensive gold prospecting. They knew the surface resources, timber, fish, furs, but had no idea what was underground. And when you're hemorrhaging cash on a distant colony, you don't invest in multi-year exploration projects. You exit while you can still get a buyer. That's stage 1, the overextension that makes liquidation inevitable. Stage 2 is where the deleveraging crisis removes all negotiating leverage. France 1803, Napoleon faced British naval blockades and looming European war after the Treaty of Amiens collapsed, requiring immediate war funding that Louisiana revenue could never provide. Britain, 1946, faced £3.5 billion in war debt and lend-lease obligations, forcing the dismantling of the sterling area and a 30% devaluation within 3 years. Russia, 1867, faced the identical deleveraging crisis, war debts exceeding 3 times annual revenue, forcing systematic asset review and liquidation. This is stage 2, deleveraging crisis. Here's why this matters to you. When war debts exceed 3 times your annual income, everything becomes negotiable. Your house, your savings, your future earning power. Russia's war debt from Crimea was £100 million against £33 million in annual government revenue. That's not a deficit you grow your way out of. That's a restructuring event waiting to happen. The Crimean War, 1853 to 1856, was a catastrophe for Russia. They lost to a coalition of Britain, France, and Ottoman Empire forces. The Black Sea Fleet was destroyed. Sevastopol fell after an 11-month siege. And when peace came, Russia faced not just military humiliation, but fiscal insolvency. Picture the finance ministry in St. Petersburg, 1865. The war debt is due, domestic bond markets are nervous, European creditors are asking questions about repayment capacity. And Tsar Alexander II has committed to serf emancipation. Freeing 23 million people requires capital for land, redistribution, infrastructure, and preventing social upheaval. Every line item on the budget is being scrutinized. Which assets generate positive cash flow, which can be liquidated, and which are just burning money while creating strategic vulnerabilities. Here's how debt crises force asset sales. The Russian government had 3 options. Raise taxes, which was politically dangerous after military defeat. Borrow more, but credit markets were already stressed. Or liquidate non-core assets. Alaska qualified immediately. The debt service math was brutal. £100 million at 5% interest equals £5 million annually, roughly 15% of government revenue going just to interest payments. Meanwhile, domestic investment needs were massive. Railway construction to connect European Russia to resources in the East. Industrial modernization to compete with Britain and France. Military reform to rebuild after Crimean defeat. Russian America generated zero contribution to any of these priorities. The fur trade revenue of 200,000 rubles annually didn't even cover the administrative overhead. The territory couldn't be taxed effectively, population too sparse, too distant. And maintaining it required capital investment Russia couldn't afford. Fortifications, supply ships, naval protection. The deleveraging pressure created urgency. Every month Russia held Alaska was another month of negative carry. Every ruble spent on resupply was a ruble not available for debt service or domestic investment. The finance ministry's calculation was ruthless. Liquidate now while there's a buyer, or watch Britain seize it in the next conflict for zero compensation. Here's what this means for you. This is the exact mechanism that drives foreclosure sales. When your debt service exceeds your income, you don't wait for the perfect price. You take the first reasonable offer to stop the bleeding. Russia needed $7.2 million, immediately more than they needed Alaska's theoretical future value. The debt crisis changed negotiating dynamics with potential buyers. The United States knew Russia was distressed. Baron de Steckel, Russia's negotiator, couldn't credibly threaten to hold the territory if the U.S. didn't meet Russia's price. Everyone understood the British Navy could take Alaska in the next war. The deleveraging crisis turned Russia from seller into desperate seller, and that's reflected in the 1.2 cents per acre price. You might be thinking, Russia could have just held the territory until the debt crisis passed, then sold at a better price. Here's the problem with that assumption. The debt crisis wasn't temporary. Russia's fiscal model was broken. The serf-based economy couldn't compete with Western industrialization. Modernization would take decades and require sustained capital investment. Meanwhile, every year of holding Alaska meant another 200,000 rubles in losses, another year of British threat, another year of opportunity cost, and, if war came with Britain before the sale, Russia loses everything. The wait for a better deal strategy only works if you have time. Russia didn't. Stage 2 established the urgency. Stage 3 is where desperate sellers meet opportunistic buyers, and the fire sale execution begins. France, 1803. Napoleon's negotiator Barbe Marbois offered Louisiana to U.S. envoy Robert Livingston for $15 million in April, with a 30-day deadline because French war planning required immediate cash. The treaty was signed before Thomas Jefferson even knew the full territory boundaries. Russia, 1867, executed the identical playbook. Baron de Stuckel negotiated in secret, Seward signed at midnight, and Congress ratified before opposition could organize or resource surveys could reveal the territory's true value. This is Stage 3, fire sale execution. Here's why this matters to you. When you're selling under duress, you lose 50 to 90% of an asset's value because buyers know you can't walk away. Russia sold 586,412 square miles, 365 million acres, for $7.2 million. That's 1.2 cents per acre. A parking space in Manhattan today costs more than 100 acres of Alaska cost in 1867. The negotiation happened in secret. Secretary of State William Seward and Baron Edward de Stuckel met privately in Washington, March 1867. No public bidding, no competitive process, no resource appraisal. Just two men, one treaty, and a midnight signing to avoid political interference. Picture Seward's office, late March 1867. De Stuckel arrives with authorization from St. Petersburg. Accept any reasonable offer, close immediately. Seward knows Russia is desperate. The Crimean War debts are due, British naval threat is real, and no other buyers exist. The opening bid, $5 million. De Stuckel counters, $7 million. Seward agrees to $7.2 million to create the appearance of negotiation. The entire price discussion takes less than 2 hours, for a territory twice the size of Texas. Here's how fire sale pricing works. In a functioning market, sellers get multiple bids, time to evaluate offers, and leverage to negotiate. Russia had none of these. The United States was the only credible buyer. Britain was politically unacceptable as Russia's enemy. France just exited North America. No other power had Pacific interests. The pricing mechanism ignored resource optionality entirely. The $7.2 million figure was based on three inputs. First, estimated annual fur revenue of $200,000. Second, infrastructure value of 40 Russian outposts. Third, land cost comparable to Louisiana Purchase adjusted for remoteness. What wasn't priced: mineral deposits, oil reserves, strategic Pacific positioning, or Arctic shipping lanes. The treaty terms were stark. Article 1, Cession of Territory. Article 2, $7.2 million gold payment. Article 6, ratification within 6 months. No resource warranties, no price adjustments, no reversibility clauses. Russia was selling as is with zero due diligence protection. De Stuckel's instructions from St. Petersburg were explicit. Close the deal before British expansion forces Russia into military defense or Congress changes its mind. Speed mattered more than price. The treaty was signed March 30th, 1867 at midnight, literally after dark to avoid press coverage before ratification. The congressional lobbying operation was aggressive. De Stuckel paid $165,000 in consultation fees to key representatives and senators. Newspapers received subsidies to run pro-purchase editorials. The narrative was managed. This wasn't buying frozen wasteland. This was preventing British continental expansion and securing Pacific naval access. Here's what this means for you. 1.2 cents per acre is the price of panic selling. For context, the U.S. government was simultaneously selling Midwest farmland at $1.25 per acre under the Homestead Act, 100 times more than Alaska cost. This is equivalent to selling your house for 1% of market value because the foreclosure auction is tomorrow, and you'll take anything to avoid total loss. The fire sale created precedent for future continental expansion. Hawaii annexation in 1898, Philippines purchase in 1898, and Panama Canal Zone acquisition in 1903 all reference the Alaska Treaty as legal framework. The U.S. learned that distressed empires liquidate assets cheaply, and positioned to be the buyer of first resort when European colonial overhead becomes unsustainable. You might be thinking, if Alaska was so valuable, why didn't American prospectors and business interests discover the resources before the purchase and warn Congress it was worth more? Here's the problem with that assumption. Alaska was Russian territory. Americans couldn't legally prospect there without Russian permission, which wasn't granted because Russia wanted to preserve firm monopoly. The few American traders who operated illegally in the region knew about gold traces in river systems, but that information didn't reach Washington policymakers. And the secrecy of the treaty negotiation meant no time for external appraisal. Seward and de Stuckel negotiated privately, signed at midnight, and pushed for immediate ratification, specifically to prevent detailed scrutiny. By the time geologists could have assessed the purchase, the treaty was already law. That was Stage 3, the execution at 1% of actual value. Stage 4 is where the buyer discovers what they really bought, and the seller realizes what they lost. France, 1803. The Louisiana Purchase produced immediate returns. Lewis and Clark Expedition, 1804 to 1806, mapped river systems for transport. New Orleans port generated trade revenue within 5 years, and lead mining in Missouri began large-scale operations by 1810. Within 50 years, oil discoveries in Texas and Oklahoma returned the $15 million purchase price hundreds of times over. Russia's Alaska liquidation followed, the identical post-closing revaluation. Within 30 years, gold discoveries alone exceeded the entire sale price by 79 times, and century-long resource extraction would reach $1.7 trillion. This is Stage 4, asset stripping, where the buyer discovers what they actually bought. Here's why this matters to you. Imagine selling your house for $10,000 because you needed quick cash, then watching the buyer find $800,000 in gold bars hidden in the walls. That's the Alaska revaluation at scale. The Klondike Gold Rush began in 1896, just 29 years after the purchase. Between 1896 and 1906, miners extracted $570 million in gold from Alaska and Yukon Territory. That's 79 times what the United States paid for the entire territory. And the gold rush was just the beginning. Picture the scene: August 1896, Rabbit Creek, later renamed Bonanza Creek, in the Klondike region. George Carmack and his indigenous partners discover gold nuggets the size of peas lying in the creek bed. News reaches Seattle in July 1897 when the steamship Portland docks carrying 2 tons of gold, $1.4 million in contemporary value. Within 2 years, 100,000 prospectors flood into Alaska and Yukon. Mining camps become cities overnight. San Francisco merchants outfit expeditions. Railway companies plan Alaska routes. And the U.S. government realizes it bought not wasteland, but the largest gold deposit discovered since California, 1849. Here's how post-closing asset revaluation works. The $7.2 million purchase price was based on surface-level value. Fur revenue, existing infrastructure, strategic positioning. What Russia didn't price, because they never surveyed, was what lay beneath the surface. The gold deposits were extraordinary in scale and accessibility. Placer mining, which is surface-level stream deposits, allowed individual prospectors to extract gold without heavy machinery. The Juneau Gold Belt produced $150 million. The Nome District added $112 million. The Klondike, technically Yukon, but accessible only via Alaska, produced the largest single haul. Total gold extraction, 1880 to 1960, $1.6 billion in contemporary value. But gold was just the first revaluation. In 1968, geologists discovered the Prudhoe Bay oil field, 25 billion barrels of recoverable reserves, the largest oil discovery in U.S. history. At modern extraction rates and prices, Prudhoe Bay alone has generated $400 billion in value. The Trans-Alaska Pipeline, built 1974 to 1977, required $8 billion in investment, demonstrating how radically the value proposition had shifted since 1867. Then the fisheries revaluation. Bristol Bay salmon runs generate $2 billion annually in the modern economy. The Bering Sea pollock fishery supplies 50% of global whitefish production. Crab fisheries support $600 million in annual revenue. These weren't resources Russia extracted because their fishing technology couldn't operate at the scale or in the conditions required. The strategic positioning revaluation came during World War II. The Aleutian Islands became the Pacific Northern Defense Perimeter. The Japanese invaded Attu and Kiska in 1942, the only U.S. territory occupied during the war. The ability to stage forces from Anchorage and Dutch Harbor was critical to Pacific theater logistics. Alaska's value as military infrastructure exceeded the entire $7.2 million purchase price in 1942 alone. Rare earth minerals added another layer: graphite, antimony, tin, and platinum group metals. Timber resources in Tongass National Forest. 17 million acres of commercial-grade softwood. And the future value still accumulating. Arctic shipping lanes as climate change opens the Northern Sea Route, estimated to reduce Asia-Europe shipping time by 40% and generate $500 billion in trade route value. Here's what this means for you. Total estimated extractable value from Alaska across 157 years of U.S. ownership is $1.7 trillion. Russia sold that for $7.2 million. That's a 23,600% return for the buyer. It's equivalent to investing $1,000 and receiving $236,000 back. Russia got $7.2 million. The U.S. got a Pacific empire and resource base that funded 20th century industrial supremacy. The resource discoveries created secondary economic effects beyond extraction value. The gold rush drove railway construction, steamship industry expansion, and development of Seattle and San Francisco as Pacific trade hubs. The oil discoveries funded Alaska statehood in 1959 and created the Alaska Permanent Fund, $80 billion sovereign wealth fund distributing annual dividends to residents. The strategic positioning enabled U.S. influence across the Pacific Rim, Philippines access, Hawaii integration, post-World War II, Japan relationship, and containment of Soviet Pacific Fleet during Cold War. You might be thinking, Russia couldn't have known about resources that required 20th century technology to extract. How could they price oil reserves in 1867 when industrial drilling didn't exist yet? Here's the problem with that assumption. Sophisticated buyers price optionality even when current extraction isn't feasible. The U.S. didn't know about Prudhoe Bay in 1867, but they understood geological principles. Sedimentary basins in Arctic conditions suggested hydrocarbon potential. They understood that 586,412 square miles of unexplored territory statistically contained valuable minerals. They priced the option value of future discovery, even if they couldn't specify what would be found. Russia priced only current cash flow, which was declining furs, and ignored the optionality entirely. That's not unpredictable bad luck. That's valuation malpractice driven by fiscal desperation. Stage 4 showed the asset's true value, 23,600% return over 157 years. Stage 5 is where we calculate the strategic cost. What Russia lost beyond the dollars. Britain, 1956. The Suez Crisis revealed that losing the sterling area meant losing the ability to project power globally. Without control over payment rails and resource access points, Britain couldn't sustain military operations beyond Europe. Spain, 1898. Losing the Philippines and Cuba in the Spanish-American War ended Spain's status as a great power because territorial reach determined great power competition. Russia, 1867 to 1905, discovered the identical truth. Liquidating Alaska meant losing the Pacific, and losing the Pacific meant Japan could destroy Russia's eastern fleet with impunity during the Russo-Japanese War, 1904 to 1905. This is Stage 5, balance sheet, the final accounting of what was really traded. Here's why this matters to you. This isn't just about money. Russia sold its future as a Pacific power for the price of short-term debt relief. And within 37 years, that choice determined the outcome of a war. The Russo-Japanese War, 1904 to 1905, was a catastrophe for Russia. Port Arthur fell. The Russian Baltic Fleet sailed 18,000 miles around Africa to reach the Pacific, only to be destroyed at the Battle of Tsushima. Japan emerged as a great power. Russia faced revolution. And one of the reasons Russia lost? No. Alaska meant no Pacific logistics base, no resupply capacity, no defensible eastern position. Picture the strategic map in 1904. Russia controls Port Arthur, modern Lushan in China, and Vladivostok, two naval bases 800 miles apart. Japan controls the Sea of Japan between them. Russia's Pacific Squadron is isolated, dependent on supply lines from European Russia that require either the Trans-Siberian Railway, which was incomplete until 1916, or shipping around Asia. Now imagine if Russia still held Alaska. In 1904, Anchorage, or Sitka, becomes a fortified naval base. Aleutian Islands provide staging points. Supply lines from San Francisco to Alaska are 1,800 miles, far shorter and safer than Baltic. Fleets wrote, the strategic geometry of the Pacific War changes entirely. Here's how territorial control determines great power outcomes. Naval warfare in the Pacific required logistics bases within range of operational theaters. Japan had this, home islands close to Manchuria and Korea. Britain had this, Singapore and Hong Kong. The US was building this. Hawaii annexed 1898. Philippines acquired 1898. Guam. Russia in 1904 had Vladivostok and Port Arthur, both vulnerable to Japanese siege and zero fallback positions. When Port Arthur fell in January 1905, Russia's Pacific Squadron had nowhere to retreat except Vladivostok, itself blockaded. The Baltic Fleet's deployment was desperation. Admiral Rosh Hestvensky sailed 18,000 miles with no friendly ports for resupply, arrived exhausted, and faced fresh Japanese forces at Tsushima Strait. If Russia controlled Alaska, the Baltic Fleet could have resupplied at Dutch Harbor in the Aleutians before engaging Japan. Vladivostok becomes less critical because Alaska provides alternative Pacific basing. Japanese forces must split attention between Manchuria and potential Russian operations from Alaska. The entire Pacific strategic balance shifts, but Russia liquidated that optionality in 1867 for $7.2 million, and the strategic cost compounded. Losing the Russo-Japanese War triggered the 1905 revolution. 3,000 killed in Bloody Sunday. Strikes paralyzing the economy. Nicholas II forced to grant Duma, which is parliament. The defeat discredited the Tsarist regime and set conditions for 1917 revolution. The broader balance sheet, Russia's Pacific presence, collapses. Soviet Union later compensates by building Pacific Fleet at Vladivostok and seizing Kuril Islands from Japan in 1945, but never regains the territorial reach Alaska provided. The United States uses Alaska to dominate Pacific. World War II staging. Cold War early warning systems, which is the DEW line. Strategic bomber bases, and today's missile defense sites monitoring North Korea and China. The resource balance sheet, $1.7 trillion in extractable value over 157 years. Russia received $7.2 million, spent it on debt service and domestic programs that failed to prevent revolution anyway. The US received resources that funded industrial expansion, military capacity, and 20th century superpower status. Here's what this means for you. Selling strategic assets during fiscal crisis creates cascading consequences across generations. Russia's 1867 decision to liquidate Alaska for immediate debt relief contributed to losing the 1904 war, which triggered the 1905 revolution, which weakened the regime before World War I, which enabled the 1917 Bolshevik takeover. You cannot separate the $7.2 million fire sale from the century of consequences that followed. Strategic assets have option value that compounds across decades, and liquidating them for short-term cash flow is how empires collapse. The Alaska sale established precedent that shaped global geopolitics. European colonial powers saw Russia's liquidation and understood that distant possessions become liabilities during fiscal crisis. Britain accelerated strategic withdrawal from India in 1947. Africa in the 1950s and 60s, and east of Suez in 1971. France liquidated Indochina after Dien Bien Phu in 1954. The pattern: when war debts exceed 3 times revenue, empires sell territorial control for immediate liquidity, and buyers, often the US, acquire century-long strategic positions. You might be thinking, even if Russia kept Alaska, they still would have lost the Russo-Japanese War because Japan had superior naval technology and tactics. Here's the problem with that assumption. Wars are won on logistics and sustainment, not just tactics. Japan's advantage was concentration, fighting close to home with short supply lines. Russia's weakness was distance, fighting 5,000 miles from European Russia with tenuous logistics. Alaska doesn't guarantee Russian victory, but it fundamentally changes the strategic equation. The Baltic Fleet disaster at Tsushima happened because they arrived exhausted after 18,000 miles with no resupply. If Alaska provides a Pacific logistics base, that changes naval force ratios, changes Japan's invasion calculus, and potentially prevents the war entirely because Russia's Pacific position is defensible. The counterfactual matters. Russia's decision in 1867 eliminated strategic options they desperately needed in 1904. That's the balance sheet. Russia liquidated $1.7 trillion in resources and century-long Pacific strategic positioning for $7.2 million in debt relief. The U.S. paid 1.2 cents per acre and received the foundation for Pacific dominance. The deal closed in 1867. The consequences are still compounding. This is the 5-stage pattern of imperial liquidation. Overextension creates negative carry. Deleveraging crisis removes negotiating leverage. Fire sale execution transfers control at 1% of value. Asset stripping reveals what was really traded. Balance sheet shows the strategic cost compounding across generations. Russia needed debt relief in 1867. They got $7.2 million. The United States needed Pacific access. They got $1.7 trillion in resources and century-long strategic dominance. The pattern says, whatever you sell in crisis, your rival uses to destroy you within 50 years. Russia sold Alaska in 1867. Japan destroyed their Pacific fleet in 1904. That's the cost of 2 cents per acre thinking.